Hey, what's going on, cash flow hackers? It's Chris with Life 180. In this video, I'm going to be going over some marketing material for the PacLife Trident IUL. I've been having some agents reach out to me. I had one agent reach out who is a follower of the channel, engages a bunch, and said, Chris, you're wrong. There's this product that is able to do all these things, and you don't know what you don't know. He said to me basically, and so he sent me this material, and so I'm going through it, and I'm doing a video on it now to kind of break down this marketing material and kind of go from there. So why don't we do this? I'm gonna go through this. So I got this up on my board. I'm gonna switch the view to this board here. All right, so let's see. I got myself down in the corner here. That transition was a little weird, but we'll make this happen. All right, so what we can see here is this PacLife, it's understanding indexed account choices. So it's ultimately what they're doing is they're getting really, really creative in how they can go about this. So they, I'm not going to get into anything right now until I go through this thing. So I want to read some of this fine print for people. Okay, so your choices for interest crediting potential. So this product is being sold as this like really flexible, giving you a lot of choices, a lot of blends, like let's just call it product diversification, like investment diversification, indexing diversification inside of the IUL. And so here we go. Check this out. I'm going to use my green highlighter to go over what I already did here. Each premium you pay into an IUL policy is first applied to the policy's fixed account. If you choose to leave your premiums in the fixed account, your policy will perform like a typical universal life policy. This is really important to say. And I love when I find languaging like this on IULs. I always tell people the reason I don't like index universal life, and I know for the IUL agents, you're going to hate me saying this, but I always call it an IUL. It's basically like putting lipstick on a pig, because universal life is garbage. It's been proven to be trash as a product, as a policy in general. But the bottom line is, and you look back to the early 80s when it first started by E.F. Hutton, and all the way through it had this massive climb in market share, and it crashed because it just, so many policies lapsed and so many people had so many problems with it. All they did with Index Universal Life is they kept the IUL chassis and they attached an option strategy to it. It's really that simple. That's all Index Universal Life is. And as I go through this, you're gonna see as I break it down that it's not more complicated than that, and it'll make sense. So here we go. For greater interest crediting potential, you may choose to allocate funds to any combination of indexed accounts as frequently as once per month. Each transfer into an index account creates a unit of value called a segment. Interest is credited at the end of the segment term. Policy charges are deducted monthly and will come from the fixed account until exhausted, and then from each index accounts by the percentage of allocations into them on a pro rata basis. Talk to your life insurance producer to learn more. Okay, here we go. Next page. So, good stuff. So now what it does is it gets into the interest indexing account options, right? So there's a lot of account options here. You can see that I've got some different things in here as far as options go. So let's just go through it one by one, and I want to show this, and I've got some things here, some real key points to kind of highlight. So you can see we have a fixed account. This is effectively the traditional UL account. That's how this is going to work. This account here is the UL account. Then we have a 1-year indexed account, right? It's got an 8.5% cap rate, okay? 100% participation rate, which is guaranteed. Okay, they have a 8.5% cap rate, 2% guaranteed. So that means this cap rate can be reduced to all the way down to 2%, right? So they have the ability contractually to reduce this cap rate from 8.5% where it is right now, all the way down to 2.5%, or to 2%, sorry. This is in the S&P 500 index. Now, when you go down lower, what you see is you have the 1-year international index. They basically put a third of each for this index into the MSCI, the EAFE, and the MSCI emerging markets. And now when we look at this, we see it's 100% participation rate with a 9% guarantee, or with a 100% of that guaranteed. And then we have 9% cap rate, once again, a 2%. So they can reduce that all the way to 2% as well for the cap rate. Once again, the company controls these moving levers, okay? Let's go to the next one. All right, the next one is a 2-year indexed account, and it shows the S&P 500 is the index that we're using. It's got a 21% current cap rate over 2 years. Now, what does that mean? That means that over 2 years, we have 10.5% annual growth. 21 divided by 2 is 10.5. And a 4%, where's the 4% guarantee? Right here, over 2 years. So that's a 2% annual guaranteed on this policy. So once again, can be dropped to a 2% effective annual guarantee. Now, the thing with this to understand is, it's a little bit different, because you're talking about if you have it's done from a point-to-point perspective over a 2-year period. So in a way, I actually like this 2-year option more, because it gives a little more longevity and flexibility to what's happening. But the bottom line is, as far as stability goes, and so this 21% looks really attractive, but the bottom line is they have the ability to reduce this to 4%, right? Like, so it doesn't matter what it looks like right now, they have the ability to reduce that, and that's important to understand. And I'm going to get into explaining more about that why in a second. So the high participation rate, 5-year. So there's no caps on this, okay? This goes back into, they created these no cap products right here based on Regulation AG 49A. When Regulation AG 49A was created, these companies created a lot of no cap products. 110% of the S&P 500 gains over a 5-year with no cap at current basis. So what does this mean? There's no current cap rate. That's cool. 10% over 5 years guaranteed minimum. That means that it's going to give you what? A 2% annual guaranteed minimum. So that's not the guaranteed floor, that's a guaranteed minimum. So it's guaranteeing you that. That's a good thing. But the thing is, the risk for this over a 5-year period is much better, right? Like there is much less, because obviously the markets over a 5-year period are not going to have that much of a negative. We don't have 5-year periods that go significantly down. So the risk is mitigated by the longevity of this 5-year period right there, right? Like, that's important to understand. 110% participation rate, 105% is guaranteed. So that's actually pretty good. Credits currently, so this actually looks like a pretty basic, straightforward index strategy. This one right here, this bottom one is pretty straightforward. What you see is what you get. I actually like that, based on the fact that it's completely transparent, because of the fact that you can't see, you are really participating in the index, and they don't have the ability to move this a lot of ways, right? So you're really, they can move it 5 percentage points from 110% participation rate to 105 on the guarantee minimum, but there's no cap, and they guarantee at least 10% growth over a 5-year period, which is obviously not amazing, but at least it kind of builds in a basic floor. But they're doing this because of the fact that they know over a longer period of time, they're going to be able to back that up based on market volatility and market risk. Remember, these insurance companies, if these strategies were going to perform and get these really astronomical returns, they'd be going out and they'd be doing these strategies on their own. And they're not doing these for the general fund. They're utilizing this for your account. The key thing to understand here that I want to show is it doesn't matter. Actually, I'm gonna kind of highlight this a little bit. It doesn't matter if we're talking about this S&P with 8.5%, or if we're talking about this one with 21%, which is basically 10.5% per year, 2% guarantee, 2% guarantee. If we got the S&P 500 here, it all boils down to, none of this indexing stuff matters. What it really all boils down to is that it comes down to, what is the yield of the general fund of the life insurance company. Right now, let's say it's roughly 4%. And that is going to create a hedging budget, an options budget. So what that does is it creates a hedging budget. And then that hedging budget is then used to buy options, right? And so the other variable that comes into play is options cost. So when we look at these things, these are the components to the policy that really matter. And the bottom line is it doesn't matter which one of these indexes we use here. At the end of the day, we're still dealing with the same general fund account. We're still dealing with the same hedging budget because that doesn't change, okay? And then what happens is we're still dealing with the same options budget with all this. So at the end of the day, all these, the only one that I think may be a little different is this one down here, because of the fact that they may have a different option strategy because it's a longer term. So because it's a longer term, the options cost might be a little lower. I haven't looked into that, quite frankly, but out of all of these options, I got to tell you, that's the one I like the most so far, right? And so let's keep going. But that's a key point to understand. So then we go in, and that point that I just talked to you about, the options budget, the options cost, all that stuff, absolutely applies here, right? So the 1 year high cap flex index account, right? So what are we looking at here? That means 55% of the S&P 500 gains not to exceed 13%, right? So what does that mean? It means 55% participation rate, right? So that means you're getting a 55% participation rate in this policy, and you can earn up to 13% right now. So that means, that's a confusing way to say, I guess I'd have to go 13%. Let's do this. 13% divided by 0.55. So this policy could basically would say you can earn up to 13% crediting, but it's 55% of the market performance in the S&P 500 index, which effectively would be a 23.63% S&P 500 index. So if the S&P 500 did 23%, you would be credited 13%. That is what this index is saying. And so the thing is, they can reduce this to a 10% guaranteed. So they and then on the 55%. So remember, these are moving parts in these that they can say. So they can drop the 55% participation rate all the way to 15%. So if they reduce that, just so you know, that same let's see here. Let me go here. This is pretty crazy. So that same 23% that yielded 13% there, they have the contractual ability to lower that to 15%. So 23.63 times 0.15 could go all the way down. This policy could go all the way from 13% to 3.45% just on that one little thing alone. So it's really important to understand all these moving parts. Once again, do I think they're going to drop it that much? The answer is no. I don't think they will drop it that much. However, it's a matter of control. When I talk to people about what financial instruments you want to use, it's all about control. You can't speak out of one side of your mouth and tell people that you need to pull your money out of a 401k because you don't control it and you're in business with the government, and tell them to put it into a policy like this where they have no control over any of this. They're basically transitioning the government for a company like this. And the bottom line is, you are a profit center for the life insurance company. You are not, like, I know a lot of people like to sell PacLife as this like company with longevity and history and track record of success, and they used to do a lot of whole life, and all that stuff is true, but guess what? Not anymore. They're in the IUL space, and their first responsibility is not to the policy holders here, it's to the company and the profitability and meeting the guarantees of their other products that they actually have guarantees behind, right? So like, that's important to understand. So now when we go to the 1 year no cap flex, so what are we looking at here? So what do they have here? They have the 100% participation rate, which seems good, but once again, they can reduce it to 20% right there, and they have a 8.5% threshold rate, meaning the S&P has to earn greater than 8.5% before you get anything, right? And that can be increased all the way to 10%. So that means your policy wouldn't get credited anything until it got over 10%. Think about that. It's kind of nuts when you break that down. Like I don't know, nobody, this is just, it's S&P, whatever. This is just not a good one. Don't do that one, in my opinion. All right, so here we go. Now what they do is they add in these plus index accounts. So let's see here. Let's do this. I'm going to read this like this. Index accounts with plus in the name offer a segment adjustment factor, which can increase the account's interest crediting potential. These accounts are available only through the election of optional additional index account riders at policy issue. So here's the deal I'm going to say with this. Anytime they do anything like this is kind of like PacLife led in 2015 when Regulation AG 49, the original AG 49, before they updated it with AG 49A in 2020 in December. When AG 49 came out in 2015, what happened was they got rid of all the illicit activities with illustrating arbitrage and having the ability to like really illustrate high returns in these. It was kind of the wild west. PacLife led the charge as far as like multipliers as a way to get ahead of the curve and still be able to illustrate at really high rates. But what happened was AG 49A came out and said, listen, these multipliers are not coming through. All they're doing is putting more risk into the policy. And so the policies were not actually illustrating and performing according to what the multipliers were sold as. This is the same kind of thing. This plus thing here, it's a segment adjustment factor. It's different than a multiplier, but it's the same concept, right? They're charging additional fees to get you into this thing, and what they're doing is they're saying this is going to get you additional results on your in your policy. We're going to illustrate it at higher results because they can show it that way because it's a rider, but it's not necessarily going to perform that way. So when we look at this, one of the things that we want to look at is all the different factors that they have that go into this, right? So it doesn't matter here. Right now we have the maximum effective interest rate crediting. We got 7.5% on the 1 plus indexing, 1 year plus indexed account, 7.5%. It's 5% current cap rate times 1.5 segment adjustment factor, right? So what do we have? We have a 5% current growth cap. They can lower it all the way to 1%, 100% participation rate, 0% guaranteed floor. So the 1.5% current adjustment factor is what it is. But then what do? They put a monthly charge. It's not that crazy actually for this one. They put that 1% charge on there, and it looks really good. Like from that perspective. Now, this is not crazy because you're talking about a 7.5% cap rate. So this one is a much more conservative approach, but so the upside on this is not going to get you that much, quite frankly. This one, it's a much more conservative option. Now, this one here is another thing altogether. 1 year cap plus index account. Remember, you have to opt into this. You have to pay for a rider, and you're basically in that rider once you do it, right? So it's got a 15% current cap rate, right? It's got, and then the 17.25 includes all the factor, the adjustment factor that goes into it, right? You got a 15% growth cap rate. So I want to make a note here. This is where one of the agents reached out and said, Chris, you're wrong. There's a 15% index, and they guarantee that 15% can never go down. So I'm going to spend a little time on this because this is really, really important to understand. Because they go 15% cap rate, 15% guarantee. That cap rate can't go down. He's 100% right. This is the most manipulative index that I've ever seen. And here's why. Because they are playing on people's lack of understanding how these things work. Because then they say we got 100% participation rate. So the old arguments were they can reduce cap rates and they can reduce participation rates. And what did? They got away from this and they said, guess what? We can't reduce either of them. They're both guaranteed. This is amazing, right? 0% floor. Awesome. Well, guess what? Here's the deal. They have a 1.15% current adjustment factor that can be reduced to a 60%, 60 basis points minimum. What does that mean? I did the math here. That means there's more additional charges. Oh, wait, I want to show this. And there's a 0.25% monthly charge for this, 3% annualized, right? So this means these are additional charges. This is significant annual charge. This 3% annualized charge right here, that is a significant charge on this. It's important to understand. But what we look at here is this 15%, the current growth cap right here on the policy can be reduced basically to 60%, which is 9%. So because if you look at how the math on these right here is calculated, you're taking the 15% with 100% participation rate multiplied by the 1.15, that would get you the 17.25 right here. That's where that, because the current growth adjustment is there, but they could drop it to 60%, and that means they can drop effectively your cap rate to 9%. But then here's the deal, you have that 3% annual charge that comes added to it. So that effectively means your 6% is actually what the new cap rate is. But here's where it gets worse. This, because it's not actual math, because this 0.25% right here, this monthly charge, that is where I got this 3% thing here, to reduce it to 6%, that charge is actually worse because that compounds on you on a monthly basis. And so it's actually going to effectively be worse than the 3% annually, because this charge is going to go into it and compound on a monthly basis. So it's important to understand that. And so while this looks like it's got this great feature here, these things, these moving parts here are really important to understand. This is not all it's cracked up to be. It looks really good on paper, but when you understand the moving parts of this, you need to understand that that is how that works. I go through this. This is kind of breaking it all down. It's just hypothetical stuff. It really goes through a lot of the other things that I just said in there. It shows how the different factors kind of work, different segments. It's all hypothetical stuff. The other thing to look at here that I put is monthly policy charges still apply and will reduce policy values above and beyond everything that we're talking here. And then when we look at this, this is the other component that I think is, this is what they're trying to sell. They say create your own mix. This is, you can kind of do your diversification of any of these indexes that you want, pick and choose, put whatever percent into whatever thing. The money's going to go into the fixed account first and be like a traditional UL, and then you can sparse it out and do 10% here and 20% here and 15% here and 5% here, whatever you want to do. You can make up your own blend until you get to the 100% and do whatever you want to do. But the bottom line is, what did I say earlier? So the options budget, based on the general fund performance, let's call it 4%. So it doesn't matter. And then we're going to have the options cost. And it doesn't matter which index we're talking about. We're going to still be dealing with the same options budget and a relatively same options cost. And it doesn't matter what we do here. The real question is, what is the options cost? What is the options cost? What is each one of these index options cost? That is going to be the real variable that comes into play on how these perform. Has nothing to do with how they actually perform, because all the things I showed you back here about like all these moving factors with the cap rates and the shifts in the current adjustment factor and all these different things, participation rates, cap rates, all those things get moved and manipulated and changed to meet the insurance company's needs based on their options budget and their options cost. Nothing else in these policies matter. I've been telling people forever, IULs are like putting lipstick on a pig, because it's simply a UL product with an options strategy attached to it. It really is that simple. So I know that's a lot, but I want to thank you for watching this. Hopefully, if you have any questions, leave them in the comment section below. If you need me to elaborate on anything, ask any questions that you have. If you haven't already, hit the subscribe button. Make sure you hit that bell, that way you get notified every time I launch a new video. I'm doing my best to do a lot of product reviews like that. If you have a product that you want reviewed for an IUL, if you want your policy reviewed, reach out, email it to me. I'll have me and my team look it over, give you an evaluation. I'll do an analysis of any Index Universal Life company policy that you want me to look over, and we will go from there. So till next video, have a blessed, inspirational day. Talk soon. See ya.